thought it was quite interesting. There was a survey out by McKinsey last week, which surveys 1,000 executives across the globe. And to me, it just shows how optimistic business leaders are at the moment. So, despite fears that growth has peaked, we've got stimulus rolling out and running out in the US, and then there's potential changes to central bank policy. What I think the data shows you is that perhaps the economic restart that we're seeing can perhaps get the global restart going on its own without having a lot of stimulus there to really support the recovery. So what we're seeing here from the survey data is that 81% expect conditions or of executives expect conditions to improve over the next 6 months, and that's been consistently trending higher since the start of this year. And if you compare that to the start of this year, it was only just over half that was expecting that. So despite what we're seeing, look, we're seeing more virulent strains of COVID-19, but we're seeing vaccines rolled out across the world. And what executives are saying is that COVID is in fact less and less of a risk. In fact, only 28% of executives are saying, look, COVID is a threat to their domestic growth. So it goes to show how far the rest of the world has come in really adapting to the virus and getting on with the recovery. So look in our market, that positive momentum hasn't been lost here, I think. What we're seeing after running a few updates as we go into reporting season next month, and we will have a full reporting season preview out later this month as well. We're seeing one of the strongest upgrade cycles that we had for a very long time. And what this chart shows you, we'd have to go back 17 years to November 2004 before we saw a similar pace of earnings upgrades across the board. So what we're seeing across the ASX is right now 2 upgrades, or a bit over 2 upgrades for every downgrade. And it's really led by the cyclicals. So resources are 6 upgrades to 1 downgrade, energy 3 upgrades to 1 downgrade, and financials 2 to 1 as well. So, but what I found interesting when we dig into a little into the data a little further into the market in 2004, what we find is there's some pretty striking similarities to the period we're in now. And I think it's worth comparing and looking at, given our positive view of the market, and we certainly think there's a strong possibility that we will follow the same trajectory as what we saw in 2004 into 2005. So just a bit of background, 2004, while we were largely spared a recession, we were coming out of a global economic slump. This was following the dot-com crisis. We had 9/11, and it was a long drawn out recovery. But what we did see was China had entered the WTO a little bit earlier in December 2001. It was going down the path of this huge industrialization push. So it was leading to massive demand, obviously, for raw materials. So commodity prices were moving higher. Rates were also kept low coming out of that slowdown period, and Aussie housing at that point was really firing along. The economy was clearly turning around. And now here's where the comparison gets a little bit more interesting as well. So if you look at earnings growth for the market, over the next 12 months from November 2004 is expected to be 13%. If you look at the market valuation, it was trading at about 15 times 12-month forward PE. And historically, up until that point, the market was trading at about, on average, 13.8. So the market was elevated. And what we heard from the RBA, if you look through some of the statements around that time, they were actively talking about cost pressures. They were talking about labour conditions starting to tighten. And in fact, after a long period of really keeping rates on hold, they finally raised rates in March 2005, really citing inflationary pressures. So it is starting to sound familiar, isn't it? So GDP at that point was trending higher also at 4.1%. We saw the unemployment rate at that point was at 5.2%, with labour markets also tightening. So unemployment rate was also dropping. Commodity prices was moving up as the global economy started to switch on again. The currency was on its way moving higher. At that stage, it was 74 cents. And if you look at the sector performance during that period, Energy was up on the 12 months to November 2004, 53%. Resources was up 35%, and financials was up 20%. So despite all the fears about rising rates, valuations, peak growth, inflation, the market, in fact, still returned 18% over the next sort of 12 months. Now, if we fast forward 17 years to where we are now today, right? So the market is pricing in 15% growth with risk to the upside. We're seeing earnings upgrades coming through. Valuations, yes, they're elevated as well. We're trading at 18 times, 12 months forward. This month, or possibly soon, the RBA is likely to announce some tapering off or at least some changes to its bond purchase program. GDP, as Michael Knox has talked about, is likely to finish well above trend at 5.1% this year. We've got the unemployment rate at 5.1%, also dropping lower. We've got unemployment moving in the same direction as 2004. And we're seeing similar dynamics in the commodity market as well as the currency market. So while it's not 2004, I think there's enough similarities there to suggest that we could be in for another year of pretty strong gains for the market. So despite all the talk about valuations, inflation, higher AUD, ultimately, if company earnings continue to surprise positively, and if the market does continue to print some pretty solid EPS growth numbers, and the market's pricing in 15% at the moment, then I'd say we're in for a pretty strong year of returns, provided COVID remains under control. Granted, it's not 2004, and there are different risks, but I certainly think we can follow the same trajectory.